Good morning and good afternoon, all the attendees. This is the third webinar in this series from GTC, How to Trade the Financial Markets. And today we are going to cover the Glossary of Financial Markets, Part 2. I'm Nikhil Malhotra, the Chief Analyst at GTC, and I'm going to present the third webinar in the series. So first of all, I would like to remind all the attendees that we have a special incentive for all the attendees. If you are going to open a new Forex trading account using the link given in the chat box today, then you'll be getting $100 extra additional preloaded in your trading account, apart from the regular 100% bonus on your first deposit. So if you're depositing $200 in your trading account, which is the minimum deposit amount, you'll be given $200 as the extra bonus. And apart from that, you'll be getting $100 preloaded in your trading account. So instead of $200, your account will start with 500 US dollars. So use the link given in the chat box and open your new Forex trading account. So let's begin with the main topics of the day, glossary of the financial markets. So here I'll be covering today what is CFD, understanding of types of accounts based on the lot size classification, what is leverage margin and how to benefit from it, what is take profit and stop loss, what is balance and equity, what is risk and reward ratio. And the next topic here is understanding of order types. Now, what is a CFD? Basically, CFD stands for contract for difference. So whenever we are trading in an online trading account, usually all the trading accounts provided by the Forex brokers, they are CFD accounts. Means you get into a virtual contract with the broker to open a position online, either in the buy side or sell side of the market. As I've explained in my previous webinars, in online trading, we can benefit from both the direction of the markets, whether the market is going down or it's going up, you can make money both sides. So whenever we open a new trading position, means whenever you open a new trade on the Forex trading account, be it currency, be it crypto, be it stocks, be it commodities, anything which is available on the trading platform, which is a CFD trading platform, it means you are entering into a contract for difference with the broker. I'll explain the concept with a simple example. It is a virtual contract. It does not mean if you're going to buy any product, any commodity, any currency in your trading account, you will be given the physical delivery of the product. For example, if I say, if you're going to buy crude oil, it does not mean that the broker will deliver crude oil in the physical form at your doorstep. You are just going to trade on the basis of the direction of the market. So if you feel the market is bullish, you can just enter, you can use the buy button on your trading platform, on your mobile trading platform, or a desktop trading platform, and just by clicking on the buy button, you'll be opening a buy trade. And if the market goes up, you will benefit from this trade. So for example, let's say the crude oil price today is USD 100, okay, 100 US dollars. It means we are going to buy at $100 with a aim like you want to book profit when the market reaches 105. So if the market, in the real sense, in reality, if the market goes up from 100 to 105, then you'll be given $5 in your trading account. Instantly, it will be credited to your trading balance. So whatever is your opening capital, your balance, $5 as a profit will be added. Vice versa. On the other hand, if the market goes down, if the market is against your trade direction, then you will have losses in the same amount. So let's say you open a buy trade at $100, and because you're bullish, you're opening a buy trade, but the market goes down, it goes to $95. So you will have a loss of $5. So $5 will be instantly taken away in the form of loss from your balance. So everything is done online, instantly, just on the basis of the contract for difference. Okay. On the other side, if the market is going down, you can open a sell trade. And in the sell trade, if the market goes down, it is the direction of your market, it is the direction of your trade, and you will be benefited. So let's say you are going to open a sell trade for crude oil at $100 because the market is bearish. So you feel you can make money with the sell trade. And if market starts dropping from 100 to $95, you'll be given $5 profit instantly in your trading account. So if your trading account balance is 500, starting balance is 500, now your account balance grows from 500 to 505. Okay. So this is how CFD trading works. So basically here the trader expects the asset price, the price of any asset to go up or down based on the analysis of the market, and you can make. Okay, so you are not going to buy the product in the real sense. You are just going to trade in the direction of the market. So what is required to make money? Number one, the direction of the market. Number two, you just need a trading account and you need some balance in that to open the positions. So this is how you can make money in the online financial markets. So this is the same example which I've just explained. Like this gentleman, he's the trader and he opens a crude oil trading position. So let's say he opens a buy position. So he will not be getting physical barrels of crude oil at his doorstep. Instead, he'll be given the opportunity to make money just by opening a position, just by opening a trade in the online trading account. Okay. So contract for difference is nothing else. It's just basically a virtual contract with the broker whom you have your account with. So in this case, if you have your account with GTC, because GTC is offering special benefits to all the attendees during the webinar, so you can open your new trading account and you can make use of CFD contract. You can make use of this opportunity, and on the basis of the market direction, you can make some quick amount of profit. You can trade either side. You can trade to the upside, you can trade to the downside. If you feel the market is going up, you can just buy and hold your position. If you see the market is going down, you can go for a sell trade. Okay, now the next thing which I want to discuss is, which I want to bring to you is account classification. Now this is purely based on the contract size. Here, account classification. So account classification, what do I mean by account classification? Based on the lot. So now every trade which you take up in your online trading account, it has a minimum tradable value, minimum lot size. So it's not like you can just buy one unit. Okay, you have to buy one lot, and each currency has a minimum tradable lot. So the standard lot size is 100,000 units. So let's say if you're going to open a position of euro US dollar in your trading account, and if you open one lot, so the position size here would be one lot. So what I'm saying, if you write like this 1.0 in your lot size in your trading account, then you are going to buy 100,000 units of euro US dollar. Okay, so if you want to buy a smaller lot, you can break your position and you can write here 0.5, which would be half of the standard lot. So by default, the general account size is 100,000 units. So based on the lot sizes, we can classify the accounts. So how the classification goes, the first type is a standard trading account. So in a standard trading account, the minimum lot size is 100,000 units of any currency. It can be any major pair, it can be any minor pair, it can be cross currency, it can be exotic currency, any currency pair. If you're going to trade, by default, you have to open 100,000 units. So it does not mean like this is the minimum. You can break down your lot sizes when you're trading, okay, based on your risk appetite, based on your capacity of taking the risk, based on your perspective of the trade. How it all depends on your pocket, okay. But by default, the standard lots is 100,000 units. Now, the second type here is a mini trading account. In a mini trading account, by default, the trading account lot size is 10,000 units, which is 1/10 of standard. So whenever you break down your standard account by 1/10, means here one lot. If you press 1 in the lot size class, in the lot size box of your trading account, of your trading platform, then you'll be trading 10,000 units of that particular currency pair. And the next one is a micro trading account. here. The smallest one is a micro trading account. It is again 1/10 of the previous one, which is mini. So from standard, we can break it to mini, 1/10. From mini, we can again break it to 1/10, which is micro. So this is how the lot size classification goes smaller and smaller as per the type of account. So in a micro trading account, you'll be opting for 1,000 units. So one tradable lot is equivalent to 1,000 units of any currency. So this is based on the lot size classification. We have 3 types of trading accounts. So this is again the same thing which I've explained in a tabular form. So a standard lot, you'll be having 10,000 units in a standard account, and you will write volume 1. If in the same account, if you're going to opt for 0.10, it means you're going to buy 1/10, which is 10,000 units. So it will be a mini lot size. Okay. Now, if you don't want to open 0.10, you can even go for 0.01, which is the minimum tradable lot size in any account. So if you opt for 0.01, it means you are buying or selling 1,000 units, and this is called a micro lot. So even in the standard trading account, you can break down your units. You can break down your lot size. Okay. So in general, let's start from 100,000 units. Okay. Now, Forex is commonly traded in specific amounts, which is called lots, which I've already explained, and you can do it in any lot size. Like you can break it down, you can multiply. If you want to buy more than 100,000 units, instead of 1, you'll be writing 2. If you want to buy double, if you want to break it down, so you will just do 0.5, 0.10 in the multiples of 0.05, 0.01 as per your risk-taking capacity. So whenever you place orders in your trading account, in your trading platform, you have to specify the lot. So without specifying the lot, the system will not take the orders, or by default, it is going to trade minimum 1 standard lot. If by default the settings are at 1 standard lot. Okay. Okay. Now the second, sorry. Now the second term which we are going to discuss today is leverage. Now by default, as all online trading accounts are CFD accounts, so by default, all online Forex trading accounts, they come with some amount of leverage. Now, what is leverage? Leverage is nothing. Leverage is basically the broker is facilitating the client with the higher lot sizes. Means even if you put $1,000 in your trading account, but if the leverage is set to 100, so how a leverage is defined in a trading account? Leverage is always defined as a ratio. Let's say your trading account ratio is defined 1:100. Okay, by default, you're getting 1:100. Now you have the capacity to pay 100 times of your original deposit. So let's say if you have deposited $1,000 in your trading account, it will be multiplied by 100. So the amount of transactions you can take in your trading account, the value of the transaction would be 100,000 US dollars. So just by putting in 1,000 and with a leverage of 100, you will be able to make trades worth 100,000 US dollars. So broker is enhancing your trading capacity. Okay, and if the market goes in your favor, you'll be making good amount of money because your account is leveraged. At the same time, if the market goes against you, you can lose higher amount because you are trading on a bigger lot size as compared to the original capacity. So any product, let's say I'm trading crude oil right now. Okay, so if I buy 1 lot of crude oil, 1 lot of crude. Now, 1 standard lot of crude is always 1,000 barrels. This is the standard lot size of crude. So 1,000 barrels multiplied by $100, assuming the market price is $100 right now. So 1,000 into 100. So I need 100,000 US dollars to buy 1 lot of crude oil. But with the leverage set 1 to 100, assuming the leverage is set 1 to 100, I do not require such amount of money. So how much do I require? If I need to buy 100,000 worth of crude oil and my leverage is 100, I will divide the value by 100. So I just need 1,000 US dollars to buy one lot of crude oil. Now, if the leverage is set to 200, I don't even need $1,000. In this case, I'll be dividing my purchase amount by 200, so which would be $500. Okay. Now, if the leverage is set to 400, it will be even lower. So this is how the higher the amount of leverage, the lower the amount of money is required to open a tradable lot. So that's the reason all forex trading accounts, they come with leverage and people can start trading even with the smaller amount of capital. So this is the benefit of trading forex. Whereas if you're trading non-leveraged accounts, means most of the stock trading accounts, okay, different forms of financial instruments other than forex brokers, they like crypto. Even crypto does not have such high leverage. So it's usually 1 to 5 or 1 to 10 in crypto market. So forex is the most lucrative market because you get all forex trading accounts with leverage. So leverage is always set in the form of ratio, like it's written here. It's explained here how the leverage is set. Leverage is always set in the form of ratio. So either it will be 1 to 100, 1 to 50, 1 to 200, or 1 to 300. It all depends at the time of opening of your trading account, how much is leverage given by a broker. You can always choose the amount of leverage you would require when you start trading forex in the online trading accounts. Okay, now what is the benefit? Because of leverage, you're not putting the full amount. As I've explained, if you're going to buy one lot of crude oil, okay, now one lot of crude oil is 1,000 crude oil barrels. Now 1,000 barrels multiplied by today's market price, which we are assuming at 100, you need 100,000. But because of leverage, you have never deposited 100,000 US dollars in the account. You are just trading with 1,000 US dollars. So that's the benefit. So if you have started an account with $10,000, you can buy 10 lots of crude oil. Okay, so this is how you can increase the capacity of trading. You can just you can put in a small amount of money, and just by depositing a minimum amount, which is called margin, you can open bigger positions. And leverage and margin, they go hand in hand. So higher the amount of leverage, less the amount of margin required. Now, what is margin? Margin is nothing. Margin is basically the minimum amount which is required by the broker to open one trading position. So by just by giving the example of crude oil or any currency, I can explain margin to you. Let's say, how do we calculate margin required? Now, margin required is equivalent to 1 divided by your account leverage. For example, now the crude oil, again, I'm coming back to the crude oil example. For example, the crude oil value right now you're going to buy is 1 lot. So given at the price of $100 per barrel, it has 1,000 barrels. So we will write 100,000 divided by the leverage of your account. So if you just want to calculate the exact amount margin, what you will do, write 1 divided by, let's say, 100. Now, how much is 1 divided by 100? It's 0.01. So 100,000 multiplied by 0.01. So that's the amount of total money you need to open this account, which will be $1,000. So margin is directly related to the leverage given in your trading account. So we can calculate with the help of this formula, 1 divided by your account leverage, the leverage given by the broker in your trading account, multiplied by the amount of lots. So that will give you the amount of margin required to open one position. So let's say you have $10,000 funded in your trading account and you have opened 5 positions, and each position the margin required is 100, 100, 100, 100. The total margin required would be 500. So out of $10,000, 500 will be logged, 500 will be used as margin. So the remaining balance would be 9,500. It does not mean that you have used $500 or you have already lost $500. Now, if you make profit $500 on each trade, you have opened 5 positions. The total profit would be $2,500. Your original capital was $10,000. So the total money grows from 10,000 to 12,500. And once you close all the positions, the margin would be given back to your account. Okay, so it is a temporary amount which is blocked by the broker to open one position. So instead of using full amount, instead of paying full market value, you just pay a margin, a very small token amount to the broker and make use of your trading account. So leverage actually amplifies your gains because you're allowed to trade more number of trades, more bigger lot sizes, and it also amplifies your losses in case the market is against you. So many times I quote this: leverage is like a double-sided sword. It has its own benefits, but it has its own disadvantages as well if you do not know how to control your risk. Okay, so make sure when you're trading on a leverage account, you know how to manage your risk. So this is a tabular format of like ratios given here. So if we have a ratio of 400, then the margin required would be just 0.0025, and it will be $250 on a standard lot of currency, because one standard lot is equivalent to $100,000. Okay, $100,000 divided by 400 is just $250. If you have a leverage of 200, you would need only $500 to open one lot. So simultaneously, you can open multiple lots because of the margin given to you by the broker. So this is how we make use of leverage. And I've explained it has its own risk as well. So make sure you manage your risk before you start operating your trading account with high leverage. All right, now the next topic for the day is what is take profit and what is stop loss. Now, because when we are trading online, as soon as we enter into any trading position, we have one entry point. Either you buy any product or you sell any product. Either you buy any currency or sell any currency. That is the market price where you are going to enter your trade. Now, each trade, you can predefine your two exit points. So what I'm telling here is you have one entry point, but you have two exit points. You have one entry point, but you have two exit points. So this is your entry point. Entry level. Let's say you're buying any currency and you're buying at this level. If you're buying, you're worried if the market goes down, then you may have some loss. So you can always predefine your stop loss level, which is always lower than your entry level, because now you're in a buy trade. So if the market falls down, if the market goes down, you'll be having unlimited amount of loss if you have not defined your stop loss. So stop loss is nothing, it's an exit level, which is predefined in the trading system. So all trading systems, all trading platforms, you have the option to predefine your exits. As we can predefine our exit in the case of loss, we can also predefine our targets, which is the exit in case of profit. So by defining our take profit, which will be always higher in case of a buying trade, because let's say you're buying something at the rate of 100. Again, we'll come back to our favorite crude oil example. So let's say you're buying crude oil at $100, but the market starts going down. So you have always given a number here to the trading platform, which is, we can assume 95. So in case the market hits 95, the computer system, the trading system, the trading platform will automatically close your trade at the rate 95. So you have predefined. So anything, if anything goes bad, anything goes against you in the market, you'll be exiting the trade with a loss of $5. And you can also predefine your take profit, could be 110. So in case the market reaches 110, the trading system will automatically close your trade and book $10 as profit in your trading account. So this is the beauty of defining our take profit and stop loss. These are the predefined exit levels given to the trading system. Market can be favorable, market can be unfavorable. So if you are not defining, you can have like unlimited amount of loss, which is not the objective. Our objective as a trader is to make some money. Okay. And if we are going to sell any position, then these numbers will be opposite. Let's say we have a bearish sentiment and we say the crude oil should be going down. So we can sell crude oil at the level of 100. We can set stop loss higher than 100, which would be 105, and we can set our take profit at 90. So in case the market goes to 90, we'll have $10 profit, and the trading system will automatically close our trade and book $10 as profit and will be added to our trading balance, our account, the capital. Okay, so this was the example. I've just explained in simple terms what is take profit and what is stop loss. So whenever the price of instrument which we are trading, it has a take profit level, the system ensures the order is closed at that particular level whenever the market reaches that particular level, and it ensures the profit is booked. So sometimes what happens, if we do not predefine our take profit, again, I'm just giving the comparison of crude oil because we can compare the situation with the same example. Let's say I'm buying crude oil at the rate of 100, but I've not defined where to take profit. The market reaches 110. Okay, so I was in profit, but due to some reason, could be some fundamental factor, could be some other reason, could be some economic reason, the market takes a U-turn, downturn. So after reaching 110, the market starts falling. So what happens? Because we have not given any order to the system, so market reached 110. There was no order in the system. There was no order in the trading system. So the computer, the system, the trading system did not close my order, and then the market reversed. So my trade was in profit, but I could not benefit from it. Now it has reached below 100, which is my buying price. So I'm again in losses. So we should always define our exit levels. Exit levels are two types of exit levels. Either a stop loss, we can define both simultaneously. So whenever we are entering a trade, we can define 110, like just for the example sake, 110 as my take profit. I can define 95 as my stop loss. And vice versa, in case of a sell trade. If I'm going for a sell trade, in that case also, I can define my take profit, which would be a lower number because I'm selling here, and I can define my exit level in case of a stop loss, which would be higher than my entry price. So by giving take profit and stop loss numbers, the values in the trading system, we can predefine the orders, preset our orders. Okay. And we should never trade without stop loss. This is risk management, because if you are not putting numbers here, so this is the screenshot of MetaTrader trading account. So once you open your mobile trading platform, the screen looks something like this. So in the middle, we have to define the lot size, which I've just explained what is a lot size. So I'm not going to buy a standard lot. It's given 0.15, means I'm going to buy 0.15 of the standard lot. So just 15,000 units of this currency, which is GBP AUD. And here I have the option to put a stop loss number. So I have to give the market value. So I have to give the number here based on the market value. So this is the market value right now. Let's say I'm going to buy this currency. So the current market price, which is shown on the screen, is 1.7557. So if I'm going to buy at 1.7557, I can set my stop loss anything lower than 1.7557, which could be given here. So based on this example, let's say we will define 1.7500 as our stop loss level. Now, because we are buying, we should always set our take profit as well in the system. So I'm buying at 7557, so I will be benefited if the market goes up. So let's say for the same currency, I can set my take profit at 1.7700, which is higher than my buying price. So this is the example in case of a buy trade. Now, in case of a sell trade, the thing would be opposite. Let's say I'm going to sell it right now at 1.7554. So now my trade is reversed. I'm going for a sell trade. So I'm not opting for a buy, I'm opting for a sell. Pound AUD, the market price is this for sell. So I'll be entering a stop loss in case the market goes above from this level. So I have the choice to enter a number here, which is stop loss. So I can keep number higher than this. So which is 1.7600. I can set my take profit number, which should be lower than my entry price. So my entry price here is 1.7554. So maybe I can take profit at 1.7400. So I've predefined my exit levels in my trading system. So this is how, when you will open your MetaTrader account on your mobile platform, it will look something like this. I hope I've explained it well, what is take profit and what is stop loss. So these are the predefined exit levels. And whenever we are buying the market price, whenever we are buying any product at a market price, we are anticipating the market will go up and we will get profit. So if this is my buying price, let's say this is my buying level here, this is my entry level. So always in case of buying, my take profit will be higher than my entry level and my stop loss will be lower than my entry level. And it will be opposite in case I'm going to open a sell trade. So whenever I'm selling any currency or any commodity or any instrument on my trading platform, I'm anticipating that market is going down. So when market is going down, I'll be entering at a level here. Assumed I've entered my sell trade here. Okay. So I'll be benefiting if the market goes down. So my take profit number will always be lower in that case, and my stop loss will be higher than my entry level. Okay, now we should understand what is the difference between balance and equity. As I've explained, we have predefined the numbers. We have predefined our exit level. So each trade either will be making some profit or will be making some losses. Now let's say we started trading with our account balance as 10,000 US dollars. So just for the example's sake, I'm saying we have started trading with 10,000 US dollars. And after some trades, which I've already closed in profit, I have achieved $2,000 as profit out of those trades. So if my trades are closed, this $2,000 profit would be added to this 10,000 capital. So it will be added here in my balance. So balance is nothing. Balance is the total of your closed trades. So your opening capital plus the amount coming from your closed trade. So here I'm taking an example, $2,000 is the total of my closed trades. Okay, so this $12,000 will be reflected as my account balance on my trading system, on my MetaTrader account here. And now the next thing which I can see in my trading account is equity. Equity is nothing. Equity takes into consideration the total of all the closed trades plus the total of current opened trades. Now this is $12,000 because I've started my trading account with 10,000 USD. I've closed a few trades in which I've made $2,000. So my balance grows to 12,000. But at the same time, let's say I have some trades open in my trading account and these trades are negative. Okay, currently I'm holding a negative balance due to my open trades. Let's say I have a negative balance of 3,000, just for the sake of example. So if I have a negative balance of 3,000, so this 3,000 will be deducted from the total. Okay, so now 12,000 minus 3,000, my equity will be shown as $9,000 because it has taken into consideration everything, all the open trades and all the closed trades. So account balance was 10,000, added 2,000 due to closed trades, but my current trades which are open in my account, it has a negative balance of 3,000. So equity will be shown here in the system, the trading account. This is the equity section. So equity will be shown as the total from open and close trade. So 9,000 will be shown here, and my balance will be shown as 12,000 because balance comes from the close trades. Okay, so this is the main difference between equity and balance. So as a trader, we should always focus on our equity amount. It does not matter whether I've gained $2,000 or $10,000, but my current position is they're running negative. Okay, see the system, the trading system will take the total from the equity amount. So if my equity is going lower, it's a matter of concern. So as a trader, you should always focus on the equity thing. If your trades are in positive, then your equity will be enhanced. So let's say instead of 3,000 negative balance, my open trades are also plus 3,000. They're still open. They're fluctuating. Okay. It could be running 3,000. It could be running 2,500 or 3,500. So this would also be added in my balance. So my new equity would be 12,000 plus 3,000 will be 15,000, which is a good thing. So as a trader, we should always maintain our equity, healthy equity in our trading account. Okay, now understanding balancing equity. I've already explained with the help of some trades with the numbers here. Now, the next thing is what is risk and what is risk. Now, risk is nothing. Risk is basically the amount which I can probably lose in a trade. So let's say, again, coming back to my favorite example of crude oil, because I'm keeping all the examples with the same instrument and the same number in terms of value, in terms of price, so that they are easily understandable. So again, I say I'm going to buy crude oil at the rate of $100. Right now, the market price is $100. And if I have a stop loss of 95. So what is the amount of risk here? The amount of risk is the probability which I can lose if market goes against. So from 100, if market drops to 95, I'll be losing $5. So my risk here is $5. The probability of loss in case the market hits a stop loss. Okay, my exit in case the market goes against me, and reward is just the opposite thing. It is the level at which I'm going to book my profit. The probability of reward, the probability of profit in case the market hits the take profit number. I've already explained what is stop loss and take profit. So in case I'm entering a buy trade and market reaches stop loss level, it will be a loss to me. And in case I'm opening a buy trade and the market touches the take profit level, it would be the amount of profit coming to my account. So that is my reward. So a risk to reward ratio is nothing. We should always focus on the amount of reward, which is always greater than the amount of risk in my trading account. So let's say if in one account, in one trade, I'm taking a risk of $100 just for the sake of calculation. Let's say we are taking a risk of $100 in one. Okay. So I should set my take profit in such a manner that the probability should be greater than $100. So my reward should be always greater than $100. So the reward should be at least 1.5 or 2 times of my risk. So I should always set my take profit, my exit level, that in case the market reaches that level, it should give me $150. It should give me $150. So what is the reward in this trade? 150. So my risk and reward ratio is very, very healthy because my the reward potential is higher than my risk potential. It's 1.5 times of my risk. So if I maintain my risk to reward ratio, no matter, even if I'm losing in some trades, I'll be always losing a lesser amount, which will be 100, but I'll be making bigger rewards, which will be 150. So if I maintain a uniform risk and reward in all my trades, it's always better for the health of my account. My account will keep growing. But if I start playing randomly, if I do not maintain uniform risk and reward, let's say I just start taking trades randomly and I start putting the stop loss and take profit numbers randomly without any calculation, without considering the risk and reward ratio. So then in some trades, I'll be making $200 profit, but in some trades, I'll be losing $300. So does it make sense? End of the day, I've done 5 trades, 100 plus 5 trades. So I have made $500, but I've taken $500 risk in one trade, which is the 6th trade. So all of a sudden, if the market reaches stop loss, I'll be losing the profit which I've made in the full day. So it does not make any sense. So it's always advisable to maintain uniform risk. If I'm taking 1% risk, which is 1% of my total capital amount deposited, it should be 1% always. We should not change. Gradually, our account will grow. So this is how we maintain our growth in the account. This is how we aim for the targets in the longer run. Each day we are collecting some smaller profits, they are accumulating, and they are always greater than my risk. Okay, so when my risk is great, when my reward is greater than my risk, end of the month, the account will be positive. So we are just going to do a quick example here. I'm just going to make some quick calculation sheet here so that I can explain in a better way what is risk and reward and how we can benefit by maintaining risk and reward. Let's say we are going to take 100 trades in a particular period of time. Let's say we have done 100 trades in a month in our account. And in each trade, I have taken $50 risk. So my risk would be $50 in each trade. And my reward would be $100 in each trade. Okay. Now, end of 100 trades, let's say I've lost 50% of my trades. I've taken 100 trades in my trading account and my win rate is just 50%. So I've lost 50 trades. So in 50 trades, my loss would be 50 times 50. So which would be which would be $2,500. Okay. But in 50 trades, I'll be making $100 because I'm maintaining my reward higher than my risk. So my profit would be 50 times 100, which is $5,000. So here it will be minus 2,500 and my profit will be plus 5,000. So net total will be plus 2,500. So this is the beauty of maintaining risk and reward. So if I maintain higher reward and if I maintain a uniform risk in all my trades, no matter, even if I win only 50% of the times, I'll be in profit. So that's the reason I always say you have to maintain uniform risk and reward, and the risk to reward ratio should be healthy. Means your reward should be always greater than your risk amount. Okay, now the next topic of the day is order types. We can set market orders whenever we are trading, or we can set limit or pending orders, limit and stop orders, which are known as pending orders. In market order, the system will execute the trade at the given market value. It will execute the trade at the given market price. So let's say I'm going to trade crude oil at $100. So as soon as I will hit the buy option, the buy button in my trading system, the system will execute the trade right away at the price $100. But if I'm going to give a pending order, means I don't want to buy at $100. Either I want to buy when the market comes lower than 100, which is less than my current market price, or I want to buy either at a higher price due to some technical factor. Maybe we have a resistance of 102. Okay, so I'm waiting, let the market cross above the resistance price, which is 102. I'm going to buy later. So I will buy higher than 102. Let the market cross above. So I'll be putting a pending order. So in that case, the system will execute my order at a later stage. So that's the reason it is called a pending order. A market order can be for both buy or sell trade. A pending order could be both for buy or sell trade. So any side we are trading, either we are buying or we are selling, either we can execute instantly, means at market, the market order, or we can tell our trading system, we can just put a pending order and we can tell the price to the system, we want to buy at such and such price, or we want to sell at so and so price. Okay. So let's understand different types of pending orders. We have a sell pending order. We can keep, we have two types of pending orders. Number one is a sell limit order. Now, what is a sell limit order? Whenever I'm going to put a sell limit order, let's say this is my current market price. This area is the current market price. I don't want to sell right away. I don't want to sell at this level, which we can say is the level of 100. Okay. I want to sell at the level of 105. But I'm going to give an order to my trading system to keep my order pending. Whenever the market reaches 105, I'll be selling. So there will be a pending order in the system. So when the market will go higher, so whenever the market will go higher, the system will execute the trade in the sell side with the 105 as my entry level, like this. So this is a sell limit pending order. This is a sell limit pending order. So whenever I want to sell at a price which is higher than my current market price, okay, and opposite is whenever I want to sell at a price which is lower than the current market price. Let's say the current market price is 100. This is the current level. I want to sell at a price which is 95. So I'm going to give a pending order to the trading system that execute the order whenever the market reaches 95. So a sell stop order would be always lower. A sell limit order will be always higher than the current market price. Okay. And in case this is the example of sell. And in case of a buy trade, it would be opposite. Let's say I want to buy a product. The current market price is 100, but I want to buy this when the market reaches 95. So I'll be placing a pending order. The system will pick the order at 95. It will be lower than my current market price. It is called a buy limit pending order. Buy limit pending order. And a buy stop order would be if I want to buy at a higher price than the current market price. So it would be here at 105. So the order will be executed when the market hits 105. Current market price is 100. Okay. So a buy limit pending order is always from the lower level, and a buy stop pending order is always from the higher level. The buy limit is here, and buy stop is always on the higher level from my current market price. This is the illustration, the same example. Okay, a buy limit is always lower, a buy stop is always higher than the current market price. The green bar is the current market price. A sell limit is always higher, a sell stop is always lower. The red bar is the current market price. All right, guys. So these were the terms which we have discussed today, which I've explained today in the third episode of the webinar series. Stay tuned and join our next webinar. The key takeaways in the next webinar would be technical analysis, fundamental analysis, and sentimental analysis. The three types, the three forms of market analysis. And I would also be explaining chart types and different time frames, support and resistance, and also trend lines. All right, guys. So don't miss the opportunity. The link is given in the chat box. Please make sure you get the extra benefits. Open the new trading account. $100 preloaded in your trading account. And also we have loads of benefits for the IBs, the introducing brokers. So there's a second link given in the chat box. The introducing brokers can open the link and take advantage of the new schemes announced by GTC. Thanks and take care. See you in the next webinar.